Part 2, Section E. The topic is investment decisions, and it's only 10% of the exam, which means just like Section D, this isn't going to be what you're studying the night before, but also, just like Section D, this is 10% of the exam that you should have a target to get 100% of. We have a very limited topic here. We're talking about capital budgeting. There's not a broad scope of things here. There's nothing in here that I think is technically individually difficult. And so this is a good place to make certain that you get these 10%. Okay, there's a limited number of questions that can be asked, a limited number of topics that they can ask about within Section E. And so you want to be certain that you are in a good position to get all of the questions that you get about Section E correct. So what are the topics in Section E? Well, we'll go through and obviously expand on each of these as we go through the videos, but we're going to be looking at the capital budgeting process. We'll do that here in a moment, just as kind of understanding what it is that we're talking about. We'll spend a lot of time talking about the relevant cash flows, because it's the cash flows that are the foundation of capital budgeting. And if you can't calculate the cash flows, well, you're really going to be in trouble. And so you need to be able to calculate the cash flows, identify what cash flows are relevant, what cash flows aren't relevant, and be able to make those calculations. Then we're going to talk about a number of different capital budgeting methods. We're going to talk about the payback method, the discounted payback method, net present value, and internal rate of return. And these methods are, in a sense, using those cash flows. We calculate those cash flows, and now we need to use them. And what we're going to be doing here with these different capital budgeting methods is determining whether or not this investment opportunity, whether or not this capital project opportunity that we have is beneficial to us as an organization or not. And if it is beneficial, well, then maybe we'll do some further analysis to determine which of the beneficial projects we're actually going to be able to invest in. We may only have a limited amount of money, but we're trying to determine whether or not this project that we have an opportunity to invest in is going to be beneficial to the organization or not. We're then going to look at some unconventional situations where we have projects that are a little bit structured a little bit differently than usual. We're going to look at inflation in capital budgeting and how it is that we can address inflation if we're in an environment where there is a significant amount of inflation. We're also going to talk about risk in capital budgeting. And finally, we're going to talk about real options in capital budgeting, where we're looking at something other than just an absolute yes or an absolute no. Kind of some of those options that we have in the middle that are not, yes, we're going to invest millions and millions of dollars, or no, we're not going to invest anything. What are those different options that we have between them? So let's kind of spend here just a minute talking about what capital budgeting is. When we're talking about capital budgeting, we're talking about the process that we have, the different methods that we have to analyze the projects that we have to invest in. Now, when we're talking about capital budgeting projects, we're talking about big things. We're not talking about, should we make this investment in a newspaper ad next weekend, or should we make this banner ad on some website? We're not talking about things like that. We're talking about, a lot of times, capacity, our factory, our production capacity. Should we build a new factory? Should we rent a factory? Okay, should we buy an existing factory? Okay, large projects that have large dollar amounts, and also not only large dollar amounts, but long time periods. And so the thing that we have with capital budgeting is these are decisions that if we make the wrong decision, it's going to be with us for a while. This isn't something that, next quarter is going to, well, that's over and we're done with. We're talking about things that could be impacting the organization for years and years. So we want to make certain, as certain as we can, that we get these capital budgeting decisions correct, because they're large dollar, long term. Now, when we're doing this capital budgeting, we need to keep in mind that our objective is to make those investments that are going to maximize the value of our company and our shareholders' wealth. Okay? Ultimately, we're trying to make our shareholders, the owners of the organization, wealthy. And so that's what we're trying to do with these capital budgeting decisions. And since it's a long-term decision, it may not be something that maximizes profit next year. This may be a significant investment that's going to take years to pay off, but the payoff might be tremendously large. And so we're trying to maximize shareholders' wealth with all of these decisions that we're making, really not only in capital budgeting, but any decision we make in the company should really be motivated by trying to maximize the owner's wealth over time. Not necessarily right now, but the owner's wealth over time. And so what we're doing with capital budgeting is evaluating all of these different investment opportunities that are available to the company and trying to determine which of those investment opportunities we should make. Okay, we're going to talk about these different methods to determine whether or not an individual investment would be beneficial to the firm. Would it help the firm? Would it be a net positive to the firm or not? And all of those that are net positives, all of those investment opportunities that would be beneficial to the firm, what we need to do then is determine which of those we should invest in first, second, and third, and so on. Because we may not have unlimited amounts of money. And so we have X amount. What is the best way to invest that amount of money that we have to invest? And so again, we're looking at long-term, large value investments here generally. Now, it doesn't always have to be long-term, decades and decades. We may be talking about a purchase of equipment or machinery for the factory, not just the factory itself as a whole, but maybe we're looking at fixed assets for it, the production equipment. We're upgrading the assembly line, something like that. But even in that case where it's not the whole factory, but simply the fixed assets within the factory, we're still talking about long-term. We're not buying equipment for the next 2 months. We're buying equipment for the next 3 years, the next 5 years. And so we're talking here about these long-term, larger dollar value investments that we have. Now, we're going to talk about these different capital budgeting methods in greater detail here individually, but just kind of as a foundation. There's 4 major capital budgeting methods that we're going to look at. We have the payback period method and the discounted payback period method, the net present value method, and the internal rate of return method. Now, we need to know what these methods are and what we're doing in these, and we will. But these are also very numerical. A lot of calculations, a lot of numbers in these capital budgeting questions. Okay, just getting your mind ready for that. We're going to have a lot of calculations in these different methods. But we'll get to those methods here in a little bit. Next, I want to look at what are the stages in capital budgeting. Okay, we've got this capital budgeting process. What are the stages that we have? Now, I'm going to give you 6 stages, but if we were to go online and search for stages in capital budgeting, somewhere they'd say there's 4, somewhere they'd say there's 8. But fundamentally, whatever we break it down into, there's a number of steps that we have to go through. And so these stages, just to help you keep in mind what it is that we're doing and where we are kind of in this process, the first stage is the identification stage. We need to identify what types of projects and investments are necessary for us to be able to achieve our objectives. If we're trying to triple sales in the next 5 years, we're going to need capacity to produce that many units. Okay, so we need to know what it is that we need to be investing in, what these projects are, what these issues are that we're going to have to address so we can identify what it is we need to be looking at. After we've identified whatever type of project we're looking at or looking for, the next stage, the second stage, is the search stage where what are the options? Okay, what are the different ways we can do this? And if we're needing to increase our capacity a lot, like I already said, we can buy a factory, we can build a factory, we can rent a factory. Okay, so what are the different options that we have? The third stage is the information acquisition stage where we find out what are the costs, what are the benefits from each of these different options. What are the cash flows out? What are the cash flows in? What are the qualitative things that we need to consider? Not just the cash in and the cash out, but what about the quality of the product? What about the environmental impact? What about goodwill with our existing customers? Okay, so we need to get all of that information. And then in the fourth stage, we make a selection. Okay, we use our tools here that we're going to talk about in a little bit and determine which investment is going to best achieve our objectives. What's the best investment opportunity or opportunities? Maybe there's more than one that we're going to pursue. So we decide what it is that we're going to invest in, and then we have to finance it. Okay, we have to determine how we're going to get the money to make that investment, to make the purchase, whatever the case may be that we're doing. What is that capital investment? How are we going to get that money? And then finally, there's the implementation and control stage, where we implement the project, we monitor it over time, get some information, find out a little feedback about our system, our process. Did it work well? Did it not work well? What things do we need to do a little differently, a little bit better the next time we go through this process? But what we're looking at here in Section E is really stages 3 and 4 of this, getting that information and making a decision about what investments would be beneficial to the firm or not. The question about financing, well, that's really a Section B topic, debt or equity. Okay, and so we've got, here we're looking in Section E, we're looking at this information acquisition stage and the selection stage of getting all of the information about these different investment opportunities that we have and determining which of them are going to be beneficial and ultimately which of them is going to best help the organization achieve its objectives. Now also here's an introductory. There's a lot of terms that we're going to use, and I'm going to go through these terms and give a brief description of them. Some of these terms are going to show up again here in a little bit. We're going to see them in different places. It's possible that a question will include one of these terms, and then it's up to you to determine whether or not that term is actually relevant to the question and needs to be taken into account or not. And so we're going to look at these terms and also state whether or not this item, this cost, most of these are costs, are relevant to the capital budgeting decision or not relevant to the capital budgeting decision. So the first term is unavoidable cost. Well, the name is descriptive here, as a lot of these names are. Unavoidable cost is one that we can avoid by not making a decision or by making a decision. Depending on what we choose, this cost will or will not be incurred. And because it's an avoidable cost, it's generally going to be relevant to this decision. We also have what are called deferrable costs or discretionary costs. This is a cost that we don't have to spend. Okay? Whether we spend it or don't spend it, the company's still going to go on. It's not going to be a problem in the short term. We're just going to push it. We're going to defer it to a future period. And generally, deferrable costs are not relevant. A committed cost is a cost that we've already agreed to spend. We haven't spent it, but we've got the contract, we've got the agreement. It's just a matter of time before this cost gets spent, and because we've already committed to it, we can't do anything to change it. Committed costs are not relevant to the decision-making process because no matter what decision we make, we've agreed to spend it and we're going to have to spend that money. A sunk cost is cost that's already been spent. It's already gone. It's not committed, it's already gone. We've already spent it. And because we've already spent it, no matter what we do now, we can't get it back. So it is not a relevant cost either. The example of this is the old equipment. How much we paid for the old equipment, how much you paid for your old car, is irrelevant to your decision to whether or not to buy a new car. Because whether you buy or don't buy a new car, you're not getting that original investment back. You're not getting that sunk cost back. We also have opportunity costs. An opportunity cost is what we give up. By using this asset in this way, we give up what else we could be doing with it. I think the best example I have for opportunity cost isn't a financial opportunity cost, but a time opportunity cost. By watching this video, you're using your time doing this instead of whatever else you could be doing with your time. Okay, whether you want to, go to a movie, play a game, sleep, whatever, that's what you're giving up. By using your time for this, you're giving up that next best opportunity, that next best use of your time. So if we make an investment and we invest all our money in this, in Project A, well, the opportunity cost is what we could have done with that money. Now, hopefully, the opportunity cost is less than what we used it for. Hopefully, we're using our resources in the best way possible. Okay? So an opportunity cost is a relevant cost because it's trying to see whether or not we're using it in the best way possible. Now, an imputed cost is a calculated cost. Oftentimes, we see an imputed cost as an example would be interest. If we make this investment, we lose interest. Well, we're just calculating what that interest would have been. Okay? Again, a relevant cost. We also then have a common cost, which is relevant, or which is common between all of the options that we have. And because it's common, no matter what we choose, it's going to happen, it's not relevant. Because what we're looking for here in this whole process is we're looking for, and we're going to talk about this, relevant revenues, costs, or cash flows. Relevant revenues, costs, or cash flows. And these are revenues, costs, or cash flows that are different between the options. If we do option A or option B, it's different. That's what we need to focus on. That common cost is the same. If we do A or B, it's the same. So we don't need to take that into account. Those sunk costs from the past, whether we do A or B, doesn't change. So our relevant costs are broken down into two categories called incremental or differential. Okay? So a differential cost, revenue, or cash flow is the difference between two options, option A and option B. Okay, that's called a differential cost. An incremental cost is the difference between doing it or not doing it. We could invest in option A or not. Differential and incremental costs are technically different from each other. They are two distinct categories. There's differential when we're choosing between A and B, and incremental when we're choosing between doing something or not doing something. In kind of general discourse, however, they're lumped together, and people don't recognize that there's a difference between differential and incremental. Theoretically, there is a difference, but for all practical purposes, we can look at an incremental as the difference between option A and option B, and option B is just nothing. Okay? So we're looking for the items that are different between option A and option B, and those are the relevant revenues, costs, or cash flows, and we're going to spend time talking about, a lot of time talking about those relevant cash flows and how we calculate those amounts of the relevant cash flows. Now, we've talked about cash flows. I've said cash flows a number of times here. So let's talk about the difference between cash flows and accounting profits. Well, cash flow, as the name indicates, is cash flows. Cash in, cash out. Our cash receipts minus our cash disbursements is our net cash flow. So cash in, cash out. That's what we're talking about in terms of cash flows. Now, accounting profit is the income statement. It's that profit or loss that's calculated on the income statement using whatever accounting principles we're using. So accounting profit is that net income that we know and love. They're different from each other. Cash flows and accounting profit are not equal to each other. And they're not equal to each other because in accounting, we don't use the cash method, we use the accruals method. And so we have payables and receivables. If we sell something and don't collect the money immediately from our customer, that's counted as revenue, but it's not a cash in. If we buy something but don't pay for it yet, that's calculated as an expense for accounting profit, but it's not yet a cash disbursement from cash flows. When we're talking about capital budgeting, we use cash flows. Cash flows, cash flows, cash flows. They are a better measure of the net economic benefits and costs that come from that project. Profits becomes an accounting game a little bit, and the timing of those accounting profits. So you'll see as we go through this, when we're talking about analyzing our capital budgets or our capital projects, making those decisions about what capital projects are going to be beneficial to the organization and which ones are not beneficial to the organization, we use cash flows. Okay? What's the cash flows in year 0? What are the cash flows in year 1? The cash flows in year 2? The cash flows in year 3? And then those capital budgeting methods, the payback method, the discounted payback method, net present value, internal rate of return, are measuring, are using those individual cash flows each year to make an assessment as to whether or not an individual project would be beneficial to the firm or not beneficial to the firm. So when we're talking about capital budgeting, we're talking about big investments, large dollars, long time frames, multiple years. Okay, even the small capital project is probably a few years long if we're talking about equipment or other fixed assets. So we want to get these decisions correct. It's a lot of money. It's going to impact the company for a long time. We want to get these decisions correct. In terms of looking at the foundational topic within Section E, it is cash flows. You have to be able to calculate the relevant cash flows. If you cannot calculate the relevant cash flows, there will be a number of questions in this section you will just be guessing on. Because either the question itself is going to be, what is the cash flow in year 3? Or the question is going to require you to calculate the cash flow in year 3 and then use that information somehow. So the foundation of this is the cash flows, and that's what we're going to look at next. Building a foundation, we're going to create some numbers, we're going to do an example that we're going to use as we go through this, but what we're going to look at next are those calculations of the relevant cash flows in our capital project.